With project finance in the renewable sector, it's become a very, very mainstream activity now. Over the course of the last 10 years, it's moved from 4 or 5 transactions a year to something like 20 plus now. We're seeing appetite probably 3/4 in wind and about 1/4 in solar. And what we're seeing this year is probably a greater focus on M&A and a greater focus on portfolio refinancings rather than on greenfield activity.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues. This episode is the second in a series on global project finance organised in partnership with SMBC Group, with 4 episodes covering Europe, Australia, Asia and the US. This series is hosted by Aurora with guests from SMBC, various law firms and Aurora.
Welcome to Energy Unplugged. I'm Hugo Batten, Managing Director of Aurora in APAC and California. We're very much looking forward to today's discussion. This is the second part of a 4-part series on project finance in partnership with SMBC Group. We had an EU-focused discussion a couple of months ago, and this discussion will be focused on Australia, with the 3rd and 4th discussions on Asia and the US being released over the next 1 to 2 months. The structure is going to be reasonably consistent across the 4 podcasts, but we'll hopefully tease out some of the regional differences across the global project finance community. We have some excellent guests in today to help us with this discussion. Jeremy Hasnip, Head of Energy Transition across Australia and APAC, SMBC, based in Sydney. Jeremy's had a long and distinguished career in energy with 11 years at SMBC, but also spent time at Westpac and PowerGen. We also have Elizabeth Charlesworth, a partner at Herbert Smith Freehills. Elizabeth has spent 10 years at Freehills, but has also spent time at Linklaters. She specializes on renewable transactions, refinancings, and also works extensively with Japanese clients. And finally, we've got Rowan von Spreckelsen, principal from Aurora. He leads our research agenda across APAC. Let's maybe start with some basics then. Jeremy, how do you see the level of activity right now in the project finance space in Australia more broadly? And here I'm thinking kind of by technology, but also across the different Australian states.
Thanks, Hugo. Yes, with project finance in the renewable sector, it's become a very, very mainstream activity now. Over the course of the last 10 years, it's moved from a small number of transactions, 4 or 5 transactions a year, to something like 20 plus now. We're seeing appetite probably 3/4 in wind and about 1/4 in solar. And what we're seeing this year is probably a greater focus on M&A and a greater focus on portfolio refinancings rather than on greenfield activity. And I think that's probably a focus of the maturity of some of the projects that have been built over the last few years, leading to opportunities for original investors to sell out and crystallize development profits post-construction. Also, people looking to simplify their financings instead of individual asset levels, aggregate it and just have one facility they've got to manage for 4 or 5 assets.
Interesting. I mean, I note the focus there on solar and wind. We will come to batteries and hydrogen in a second. Elizabeth, I suppose, what are the hot topics that you're seeing in the project finance space? Like, where are the largest areas of debate and negotiation at the moment?
Yeah, sure. It's super interesting at the moment, and I think there's a huge amount of positive energy and optimism here in Australia in renewables. And as Jeremy's already alluded to, it's sort of become more of a mainstream and a number of transactions that are happening every year. But there are some real challenges that people are trying to work through. And I guess, yeah, we've mentioned wind and solar and sort of different technologies emerging is certainly one thing. But I was at the Clean Energy Council CEO forum in Canberra last week, and we heard from Minister Chris Bowen and Jenny McAllister, the Assistant Minister for Climate Change and Energy, and sort of a couple of really big themes that were there and people are talking about a lot are really what we're doing on supply chain and labour shortage in Australia, particularly with the amount of sort of transmission and grid work that needs to be done. So I think those are two key themes that we're seeing come through and a lot of debate about.
Yeah, absolutely. And Minister Bowen does have policies designed to rectify that, the rewiring the nation policy in particular. But I think there's still more detail that the industry needs to see before getting confident that there is going to be sufficient transmission to build out the level of renewables that at least organisations like Aurora model is necessary to deliver the renewables. To pivot slightly, clearly Australia, like Europe and like other jurisdictions, interest rates are rising after 2 decades of pretty low interest rates. And this is obviously going to have a material impact on the way assets are financed. This is exacerbated at the moment by Australia by some pretty sharp jumps in capital costs accompanied by real supply chain issues, so delays to delivery. Jeremy, what does a higher inflation and higher cost environment typically do to project finance terms, and what impact do you see it having on projects that are scheduled to come to market shortly?
Thanks, Hugo. Interestingly, the effect's not so much on the terms of financing, because the debt sizing criteria people are applying, how they look at how much debt you can apply against a particular project, is fairly stable over time and relatively slow to change in terms of methodology. What's really changing here is the input assumptions, that the cost of a project increases. And as the cost of a project increases, obviously the amount of debt it can support, everything else being equal, reduces. But what you find happens over time is that the conversations that sponsors start having with off-takers for their product eventually feeds through to higher prices for the sale of electricity under PPAs, and we're starting to see that effect work through at the moment. That we've had a period of very attractive energy prices from new projects, and that's increasing. Customers are initially reluctant to enter into contracts at higher prices. They want to validate that that's real, that there is cost pressure. And when you look at it from a different perspective, that with net zero targets that many people are adopting and looking to decarbonize quickly by 2030 or 2035, depending on which business, then they've got to be making those decisions to purchase power from projects now or next year. And they haven't really got that long to delay on making those purchasing decisions. So the bigger policy framework is supporting customers accept an increase in power prices, and that they can see other people are exposed to that as well. From a project financing perspective, changing inflation assumptions in models is obviously one that's going to create a bit of conflict between banks and sponsors. Traditionally in Australia, we've had very, very stable inflation for a long period of time, and custom and practice has been to use a 2.5% flat inflation assumption, mid RBA target band. We're now having conversations around, what the path is in the front years, the first 2 or 3 years that we've moved into a period of higher inflation. Should that be reflected, and how quickly does it revert to long run trend? So output on all this is that the debt numbers sort of drop out of the input assumptions, and the debt sizing criteria really don't change materially.
Interesting. Elizabeth, are you seeing changes in contracting terms as a result of higher inflation, higher project costs, and supply chain issues? How is this impacting the work you're doing?
Yeah, so I think in that, as Jeremy has said, it really is that the input of costs going up and supply chain delays is what is really the focus at the moment. And I think in terms of sort of that contracting structure for project finance, people need it and the banks need it to have some long-term revenue, and we are seeing sort of where power prices will go to and what people are expecting those forward future energy prices is kind of more important than inflation. But the level of the project that can be supported, I think, is the level of cost that the project can support with increased costs and funding, increase in inflation, increasing capex costs is then a challenge to investors if they're still trying to make a return. So unless we can see that the consumers will accept a higher energy price going forward, it will be difficult for some of these projects to get off the ground if they are financed in this way. And I think one of the things that Jeremy sort of spoke to earlier around the maturity of the market in the renewables and how people are trying to get new projects off the ground, but have already got the stability in projects that are under operations now, and that sort of portfolio style or fund structure that we're seeing a lot more of. And this consolidation is really where I see the market moving to, because I think otherwise there's not those other levers to pull if you're using a sort of a traditional PF finance structure.
Rowan, just to get into kind of brass tacks, I suppose, and both Jeremy and Elizabeth kind of touched on it there. What are you actually hearing from clients in terms of project cost increases and supply chain delays, at least in Australia?
Yeah, I mean, there's a range across solar, wind, batteries in particular, but it's anywhere in the order of magnitude of kind of 20% to 30%, potentially even higher compared to what we were seeing a year or two ago, and predominantly being driven by material costs, whether it's steel, lithium, etc. I think that's the key part on the supply cost side. In terms of the delays, we're seeing order books being filled out, even for the fastest deployment. Kind of order books are full until 2024 on take. That should be good news for some of the suppliers. I think the knock-on effect of some of this is it's creating uncertainty for the suppliers of those bits of kit, whether it's panels, whether it's wind turbines, whether it's battery cells. We're seeing contracts that they've signed a couple of years ago based on where capex was at that point in time, now having to deliver on those projects, and material costs are significantly higher, and that's having impacts on their balance sheets. So there's a lot of uncertainty around the suppliers providing the kit, which is providing a lot of uncertainty to the market more generally on those.
Jeremy, Elizabeth, you both talked there about future price expectations, which is, I suppose, at the core of what Aurora does. In the last couple of years, we've seen, I suppose, both ends of the spectrum, where during COVID, we saw very depressed wholesale prices, lots of negative prices during the middle of the day, in large part due to grid scale and rooftop solar and inflexible coal. And over the last 6 months, we've entered a period of incredibly high prices, low coal plant availability, very high gas prices, to the extent that the market operator in Australia actually had to suspend the market, which for nine or so days. Clearly, forecasting power market prices are challenging now. Rowan, when you talk to clients, what are their biggest uncertainties around future power prices? Like, what are the levers they ask us to pull when we're doing scenario analysis? And do you think the consensus has changed about where long-term prices are going to settle in Australia?
Yeah, I think there's probably two big areas on uncertainties that we get asked about most. The first is just very much what we've seen in the short term, which has been driven predominantly by commodity prices, which is always a major driver, but exacerbated in the gas context at the moment. And kind of to put a couple of numbers on the volatility you mentioned there, I mean, kind of New South Wales last year, the price on average was $70 per megawatt hour Aussie. This year it's over 200. Victoria over the last 4 years has seen similar. It went from 100 in 2019 down to the 40s and now up to over 150 again. So huge swings there. A lot of that's driven by commodity prices. I think the other key uncertainty that we're seeing at the moment is around government intervention and policy risk. Aside from what's happening in Europe and elsewhere at the moment, where governments are talking about clawback mechanisms on existing subsidy structures, given the energy crisis that's happening, there are question marks about whether or not Australia will go down a similar route, although the energy crisis is not to the same degree that it is in Europe. We've also just got a huge number of market design proposals and new policies in the market. We've got discussions around capacity markets, transmission access rights, and congestion management models. The New South Wales LTESA program is kicking off with first auctions later this year. The ESU, AEMO's kind of reliability 10-year plan has just come out with one of its most kind of dire forecasts on reliability for the upcoming couple of years. So there's big question marks about whether or not government's about to step into the market and provide kind of guarantees on pushing some of that reliability concerns down the road. So one of the big ones for us is government uncertainty at the moment.
Jeremy, given Rowan's given us a laundry list there of kind of drivers of uncertainty in the Australian market, how does your credit team think about the risks inherent in any particular project? And to your and Elizabeth's points around portfolios, particularly as you're thinking about geographically and technology diverse portfolios, which might have renewables embedded, but also flexible assets like batteries or reciprocating engines or whatever it might be.
Yeah, a lot of project finance has really been done on initially been done on projects that have high levels of electricity sales contracts. So you often hear the phrase fully contracted transaction. So that's usually the easiest for banks to get their head around. And then as you start looking at partly contracted assets, you're taking market risk and giving up what's the alternative, which is counterparty credit risk, is really what you've swapped it for by having that long-term contract. So it's the credit standing and the ability to pay of a retailer or a large electricity customer buying directly from you. So as we change through the market structure, we're probably going to see changes to the retailers and their ability to run large trading positions. A number of them have been exposed to margin calls or additional collateral for the trading position over that April to June period.
Yeah.
And from a bank's perspective, when we're lending, we're normally interested in equilibrium pricing. That's really that sort of the market's in a stable state, that you've got orderly entry and exit of generation, and that's effectively a base case. When you're looking at the events of the last few months, that's really a sort of a major deviation from equilibrium. Something's gone fundamentally wrong. In this case, gas prices are high, coal prices are high, and there's poor plant reliability. I would expect government as the extra stakeholder in the energy sector to intervene in some form to ensure that prices in the long run are efficient and close to that equilibrium level. Yes, you'll get periods of time where you get deviations from that, but you wouldn't expect that to be the long run position. So fundamentally, we're trying to make sure projects can survive in the economics of a normal world. When you get into a situation where you've got extremely low prices, then the question is, for those projects that don't have the benefit of a PPA, is the break-even price that we've assumed for them a little bit higher than the worst outcome you're going to get in a severe price depression period. And then when you've got a high price, we're probably less concerned about that, other than in certain circumstances where a project has shortfall payments to make if the customers are expecting to get a minimum generation part to the contract, and there's penalties if you fall short, and that's linked to the replacement cost of buying in high prices. So how can the project handle that? Or if you've got you've entered into an element of basis risk where you've sold a fixed hedge against a variable load profile, and you've got mismatch unders and overs that you got to trade, and you're exposed to having to purchase on market. So I think the tools are pretty good for what we've got that we now know about. We've had a few important learnings over the last few years with marginal loss factors and the work that now goes into studying that and evaluating it. The one thing that we probably need to put more effort into is understanding the frequency of negative pricing periods, because it's what debt sizing approaches traditionally assume that you've got a price downside for most of these projects, but you also need to understand what the volume downside is, and what traditionally volume downsides in a thermal market have been on plant performance issues rather than on market performance issues or grid issues with curtailment, either economic or technical. So I think there's probably more to do in that loss of volume question, maybe more than there is in the price question.
Yeah, it's a really good point, Jeremy. And for listeners who aren't deeply familiar with the Australian market, in September, October of last year, we were seeing negative prices in some Australian states up at 50 or 60% when the sun was shining. So there have been particular months where those negative price issues have been particularly painful. And it's certainly something Aurora's modeling has been, I suppose, asked to focus on more recently. So it's a really big theme. Elizabeth, market volatility, these kind of quite dramatic price swings quarter to quarter, year to year, Jeremy started to tease out some of it in specific contract structures. How is it changing people's attitudes to contracts in your experience?
Yeah, so I mean, we're talking about the energy sales contract, or the PPA, and I think having those long-term contracts in place, which are typically required for a project finance structure, has meant that in these periods of sort of unprecedented volatility, that there's been effectively winners and losers. So I think it sort of depends who you ask, but certainly on the equity investor side, and for the ability to have some of that exposure where in the last few months where the price has been really high, then everyone's optimistic and wants to have more of that exposure. But on the flip side, the price stability, and I think as Jeremy described it, as sort of swapping the market risk for the counterparty credit risk, and some of the offtakes that have been provided by sort of government or highly rated investment grade retailers and corporates, where people are able to take a longer term view and work through these periods of uncertainty, has certainly saved many a project on the downside as well. So I mean, I think that there is sort of a perception that if you can come up with a structure whereby you can take some of that risk and on a merchant exposure, but create a debt structure that provides you with the cost of capital that works for your project and what your investment returns are, then that is something certainly equity side people are keen to pursue. But and I think Jeremy talked about fully contracted 100%, but then you're facing, if there are issues and you've got outages, meeting those minimum generation or shortfall requirements is sort of something that on both sides people want some flexibility in their contracting structures. I mean, I think sort of this price volatility that we've seen recently is something that is really challenging, and certainly looking forward to sort of a more settled state of affairs when we can get there. But I think that, you know, that question of when will that be resolved and how far in the future is that is something that you know, is challenging for everyone to answer.
Mm. Jeremy, another question for you. Australia, I think, from my understanding globally, has, in terms of its EPC contracts, it's kind of the most prevalent in terms of turnkey contracts. But we have seen some of those go wrong, particularly where grid issues and delays have come to the fore, and the EPCs have borne the brunt of those. And we've probably seen some consolidation in that space as a result. I suppose this goes back to some degree to our supply chain and CapEx increase discussion. But what are the challenges with recent projects that are now using different procurement structures across EPC contracts? What are you seeing in that space, I suppose, generally in Oz at the moment?
Yeah, good question. On classic project financing, you're starting with a project company that has limited resources. It's maybe, you know, in the purest sense, got a couple of people in to manage the business, and it's reliant on being put in the position where it's got adequate resources from the outset to be able to deal with the business during the construction phase. So it's able to access enough money to pay the constructor to build it. It's able to access enough money and expertise, probably from external sources, to manage the construction activities and the planning to make sure things are actually on track, and if necessary, take some steps to bring it back on track if things start to go wrong. With EPCs, we've been very lucky over the 20 years or so that modern renewables have been built in Australia to, by and large, have most projects done on a full turnkey fixed price, fixed time contract basis. And that's certainly not the norm across all project finance classes. You generally don't see that in mining projects, and you don't see it in offshore wind, where there's a lot more scarce skills, and it's hard to get a single party to take all the risk when you've got the marine services part of that as well, and quite different technology around foundations. So what you look for as a financier in a structure where you're not able to get a full turnkey is, what are the residual risks that are left for the project, particularly in terms of delay or performance shortfall, and that it has access to adequate liquidity to be able to handle the same sorts of events going wrong, because we're not seeing any great signs that it's getting really a lot easier to get grid connections quickly, that you're not going to be surprised sometime during the construction that you need to procure some extra equipment for your substation, or that you're going to be held up for a long time during electrical testing. And in a way, the choice of where the projects are built is the sponsors, not the contractors, and yet the contractors have been up till recently accepting that grid connection risk. It's not been a particularly great bet for them on a number of projects, and I guess that willingness is beginning to evaporate. So if that changes, then sponsors will have to bring additional liquidity into the structure, additional project management expertise, grid skills as well, to be able to handle some of the things that can go wrong and put them and fix them.
Terrific, and makes complete sense. And as you say, we're certainly seeing it in terms of the quality and detail of work that is going into site selection is increasing materially as some of these issues have come up over the last couple of years. We've spent a lot of time talking about solar and wind, but I do want to pivot to financing of newer technologies. Aurora, like a lot of other forecasters, sees a material role for storage and hydrogen in the energy transition, particularly in Australia, given its natural endowments. But even in mature markets like Australia, debt funding for these technologies has been challenging for a variety of reasons. Rowan, just to kind of orientate some of our listeners who aren't in Australia, how are revenue streams evolving for storage? And can you talk a little bit about some of these longer term capacity style payments that are being discussed in New South Wales, but also elsewhere in the country, and how might they help, I suppose?
Yeah, so the Australian NEM is an energy only market. So as far as battery revenue stack currently looks like, it's predominantly energy arbitrage, buying low, selling high, and ancillary markets, predominantly around keeping the frequency stable. In terms of kind of, are we seeing longer term contracts put in place? Both of those markets are typically short term, hard to contract. And that, to Hugo, to your point, that is harder to put debt behind. They are a very volatile kind of set of revenue streams, different to a typical infrastructure or even power asset. The predominant type of longer term contract we've seen to date in the Australian context has actually been bilateral contracts with the transmission network operators, providing kind of storage as transmission. A few examples: the Victorian SIPS battery is probably one of the most recent. There's a couple of auctions in Queensland for similar. We've seen South Australian batteries providing those services in the past. You mentioned around the New South Wales LTESA program. There are a couple of other programs that are being rolled out and being talked about. The big one is the LTESA program in New South Wales, which is predominantly for 8 hours plus storage, so longer duration, long duration contract, government backed, to provide kind of certainty for that debt to put behind. The other one in the Australian context is the discussion about capacity markets. Whether or not that's coming, whether that will materialize is yet to be seen. But I think globally, the kind of trend that we're seeing is that all markets that are seeing a large turnover of the existing fleet, predominantly thermal, are asking these questions of how do we make sure that we've incentivized the firming capacity required, particularly around things like the solar ramp periods in the morning and evening, to make sure it's on time and to the required level. So most markets are thinking about what is the right structure here for some form of longer term contract, so that we can make sure that those are. And the key question is just, does that come on at a system level? It's an auction, whether it's a direct subsidy or capacity, or is it done through bilateral contracts? Those are the key kind of mechanisms.
Elizabeth, what are you seeing in the battery space? Are you working on many kind of, I suppose, battery focused projects? Before the show, we were talking a little bit about the concentration of battery providers and the limited choice available to some Aussie market participants who do want to develop battery projects. I suppose at a high level, what are you seeing?
Yeah, I mean, exactly that, Hugo. It's actually really challenging. I've worked on a couple of battery projects already this year, and those both have Tesla batteries secured. I think, though, what we have seen in recent months, and I think, you know, we have to remember that Australia is a small market when you think of these sort of no manufacturer of batteries really in Australia, and we're trying to source them from overseas. And so global events do impact the ability to ensure that batteries would be sent to Australia, and we're not necessarily top of the pecking order. I mean, Joe Biden's Inflation Reduction Act that sort of has certainly added more significance to the supply chain issue. So we are seeing only a few potential providers of batteries in Australia. There are some new entrants, but they're new and untested, and so that from a bankability perspective is something that people need to get comfortable with those suppliers. I think as well, what one of the challenges is holding the pricing. And I mean, for inverters and batteries, contractors really now are coming to the sponsors and saying, look, we can only hold pricing for a couple of weeks, and that is just not really long enough to ensure that all of the diligence and process can be worked through. So that is something that's really hard, and I think that if sponsors are trying to look and lock things in, they need to sort of be lining up and juggling a number of balls in the air at the same time, and then sort of just making a run and going for it. So those things I think are a little bit of a challenge at the moment in Australia and in the battery sector, but again impacted by global events.
Jeremy, I suppose Rowan and Elizabeth have both flagged some challenges there around battery investment cases. Do you think lenders in Australia are getting more comfortable lending to storage projects? Where are we in I suppose our evolution in this technology?
Yeah, we're still at the starting point on batteries. That the first handful of batteries that were done in this market were relatively small at the 20, 30, 40 megawatt size, which really fall outside the project financing market. And as we move up to batteries that are 100 megawatts is the minimum that you'd probably want to spend the time project financing, and things bigger than that, it's worth the transaction costs. But what we've seen so far have largely been on a tolling basis or monthly capacity fee with no market risk. So it really is a counterparty credit play. And I think we haven't really got far enough into live transactions yet as a country in Australia to get the finance community comfortable with the true level of market risk on these assets. So early days, Hugo, I think we'll see how that develops over the next couple of years as more transactions come to market. But I think one interesting play will be the extent to which batteries are seen as a physical risk management tool for the major traders, so the retailer generators with larger portfolios, and the extent to which they want to internalize the ownership of those rather than be buying services from independent operators, because traditionally risk management in power trading has been reliant on physical assets to back up positions, and ownership of open cycle gas turbines or hydro plant have been the key tools that people have had. It'd be interesting. It's going to be interesting to see the willingness of the bigger traders to allow or rely on independents to own and operate batteries, rather than the bigger players actually building very large scale ones themselves and internalizing the risk management and having physical control of managing their own price risk positions.
And then hydrogen, there's a lot of hype in the Australian market, as I think there are in all developed markets, about the potential for hydrogen and Australia potentially exporting it to Asian nations. How is SMBC thinking about hydrogen opportunities, particularly given I imagine this is a high priority for Japan HQ?
That's right, Hugo. The bank's interest in hydrogen goes back a number of years now. We were the first bank to join the world peak body, the Global Hydrogen Association, in 2018, and we're also members of the peak body in Japan. So being one of the biggest banks there, and being close to government and close to our customers, many of whom are looking at the hydrogen sector and working out how to get involved and looking for project opportunities. We follow the industries that our clients are moving into as a bank, and we can see a lot of activity going on. I think it's a bit like an iceberg. There's a lot more below the surface than you can see. A lot of people are spending applying a lot of resource to building up their capabilities in hydrogen, finding opportunities, and a lot of it's really outside the public domain. So maybe that's why it seems like there's a lot of froth. I think the reality will come, and it will come in different guises, that people are looking for ways of decarbonising the existing grey hydrogen market, half of the existing 100 million tonnes a year of hydrogen is used in the refinery and petrochem sector. So decarbonising that is probably the first big opportunity. Tackling mobility and transport solutions, big sectors like shipping are natural to replace bunker fuel with green ammonia as an early stage. Some of the heavy haulage opportunities lend themselves to hydrogen as well. And then when you look further afield, whether you're changing how we make aluminium, or how we're looking at bulk transfer of power of energy from countries that are resource rich to regions that are resource poor, in a form that is in batches, is storable, handles that time dimension. Then hydrogen in different transport mechanisms can play a big part in that, particularly into areas like North Asia with Japan and South Korea in particular. But we'll also see Europe potentially being a large importer of hydrogen. So Germany is certainly at the forefront of that. And very densely populated regions can be importers. Sparsely populated countries with large natural resources in wind and solar can be exporters. And I think the dream from an energy banker's perspective is it LNG 2.0, that essentially replaces a lot of the assets that banks have traditionally financed in the energy space.
A couple of final questions to finish up, and I might just open this up to all of you to opine. But as the energy transition is evolving in Australia, I suppose we are seeing a shift in government to more interventions to kind of keep guardrails on as we shift from a coal-dominated system to a renewables plus transmission plus storage plus demand-side response system. And in some cases, and we've touched on the New South Wales roadmap a couple of times, moving back into allocative decision-making roles. And in some ways, that's a positive, at least for project finance, because it de-risks, at least from a price perspective, some of these projects. But it does kind of raise the spectre of broader policy risks. And we're certainly seeing in Europe, with extremely high and persistently high prices, government talking about quite radical redesign, for example, splitting green and thermal power into separate markets and having different kind of dispatch for each of those markets and different contract structures. How are you thinking through policy risk as you're thinking about both project finance, but also the contracts that structure them?
after 20 years of renewables in Australia, where it's been a developer-led, almost free-for-all, there's been a lot of creativity and some fantastic projects that have been brought to market. Having a bit of a straitjacket of government deciding which regions get developed in which sequence starts to break some of that creative disorder that was there before. It'll disadvantage some project developers that have gone and explored highly prospective regions that end up being zone 2 or zone 3 in terms of the sequence government wants them to be developed, which will be frustrating for those players that have invested in those opportunities. From a bank's perspective, I think the bigger risk is going to be more in what happens when we move to a fleet that's heavily dominated by very low marginal cost producers with a very long and flat price curve, not one that's highly discriminated between top and bottom end of the curve. And my suspicion, and you touched on it earlier, is that we'll probably move to different market design, maybe a capacity market. But my concern, in 20 years' time, is we have a market where we've been reliant on price setting by people with higher, or generators with higher marginal costs, much higher costs, setting prices, and very few of those players still being on the market, other than batteries and hydro.
Elizabeth, maybe if I could ask you to come in here. Are you looking across at Europe, seeing some of these quite radical redesign suggestions? How does that inform? I mean, you can't write everything into a legal contract, obviously, but how is that informing your thinking about the type of policy and market design risks that projects may need to consider in the future in Australia?
We are looking at Europe and seeing what's happening there, and it is, I guess, a little bit worrying or dangerous, as I might call it. It is something that developers need to really be across, and I think keeping informed and understanding the different mechanisms, the different, I mean, now, as you say, Jeremy, that the reses have been announced in New South Wales. People, they're sort of winners and losers depending on where you might have been looking to put projects. That is across the whole board, the whole chain, supply chain, but also the different states of Australia, where we don't know exactly what Queensland's going to do. So I think what we are thinking about the most is, one, staying up to date, keeping informed, helping our clients, but I think as well, sort of putting some pressure on the policymakers to understand that, yes, we understand that there needs to be some mechanisms changing or market redesign that people are working through, but the need for certainty and then sticking with that so that people can be creative and actually go forward with their projects is really fundamental, because the uncertainty and the longer it goes on for, or if there is, these ideas of clawbacks or changes to policy once people have sort of put their projects in train, are even more detrimental and mean that there'll be less confidence to invest in the Australian market. And I think this is a global stage, and that's sort of high for us to inform our clients about what the risks are in that space.
I might build on that just briefly. I completely agree with Elizabeth on the certainty side. I think there is policy risk, absolutely, but to end on a slightly positive note, there is the directive from government is to provide some more of that certainty. And one of the most common questions we get as a market advisor is around the uncertainty of the network. I think one of the positives coming out of this will be the certainty around the shoring up of the network to provide that level of certainty, that level of grid planning that can allow developers to kind of plan around curtailment, around MLFs, and some of the issues we've seen historically there. There will still be winners and losers, as both Elizabeth and Jeremy highlighted, but I think around the network, we're getting to a state with the speed of the transition that we're wanting to accelerate, that we need a certain level of planning around the grid to facilitate that transition.
Yeah, Rowan, and I agree entirely with you on that. I think that's really really important, and I think there is a lot of positivity and there's a lot of work that has been done around that, and it really has escalated in even the past months, and so I think that is fantastic in terms of looking forward, and I'm excited about it.
One final question to wrap up then, and this doesn't just relate to project finance, but I think all elements of the energy system. You know, if you look at Aurora's forecast, but any other credible forecaster out there, in the Australian market, we do need to build tens of gigawatts of new renewables, both to decarbonize, but also actually to replace the coal assets on the system that are increasingly unreliable and aging. At the same time, I think we've rightly spent a lot of time on this conversation talking about the various challenges to the renewable, but also battery and hydrogen investment cases. What role can project finance play to, I suppose, simplify and expedite the process for rapid deployment of renewables? And maybe it is, to return to an earlier topic, the market responding by aggregating portfolios that can then be financed as a unit. And so it's not the role of project finance players to change the way they're thinking about problems. Is that accurate, or is there more that we could be doing to help more rapid deployment here?
Yeah, I mean, I think that is one of the key things that we are seeing happening. That, and it is certainly a way that you can accelerate the ability to get debt into new projects. I mean, we haven't talked about it terribly much, but one of the sort of other diversity pieces is these sort of hybrid or co-location projects where you're having wind, onshore wind and solar and batteries sort of all at the same place, and that helps to sort of move the cycle around. But I think actually the maturity of the market, the sort of M&A activity and consolidation that we are already seeing will help to support that, where we see these sort of fund-like structures and bigger players who are trusted developers. I think that's really important for trusted sponsors to be able to now go and lenders have more confidence that they will be able to deliver these projects, because there have been challenges in the past and we've worked through them. But if you can have a wind farm that's operational with some history, and then you're going to put other projects in different regions of the NEM and finance them on a portfolio basis, that certainly should help to speed up the deployment.
Jeremy, is that a fair summary, do you think?
It's a classic question that people always ask: can we be more efficient with how we finance projects? Can we do it faster? Can we do it simpler? And I think it ties into what happens with these assets in the longer term, that compared to historical levels, we have the most number of separately owned assets at any time in the national electricity market. We are, consolidation can drive simplification by moving to portfolio financings. You're not going to see the level of long-term contracts keep increasing exponentially on projects. That older ones will naturally become merchant and maybe contract on a more typical sort of 1 or 2 or 3 year basis with the traders, or perhaps build up other routes to market, like build up their own retail sales platform. So as people move to a more merchant basis, I think the structures will drift to a more corporate style outcome, that the sorts of leverage you can support on a fully merchant business as a project finance isn't a lot more than a corporate financing, and that that provides a simpler platform. So I think it's one that we can't solve now. I think project financing will continue to be a sophisticated financing tool that gives people access to high levels of financial leverage, and carefully sized to the risk within the business.
I think that's a great and apposite note to end on. Team, thanks so much for your time today. Jeremy, Elizabeth, Rowan, we've covered a huge amount, I think, in about 50 minutes there. You're collectively some of the busiest people in the Australian energy space, and we're incredibly appreciative of your time. All the best, and thanks again.
Thanks, Hugo.
Thank you very much, Hugo.
Thanks very much, Hugo.
That was Hugo Batten, Managing Director of Aurora in APAC and California, talking to Jeremy Hasnip, Head of Energy Transition across Australia and APAC SMBC, Elizabeth Charlesworth, a partner at Herbert Smith Freehills, and Rowan von Spreckelsen, Principal from Aurora, leading the research agenda across APAC. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.